Hi guys, I'm BP. In this video, we are going to see the chapter 2 in the book The Intelligent Investor. The chapter 2 is the investor and the inflation. Let's get started. Okay, now let us see what is inflation. Inflation is nothing but over a period of time, our money could lose its power of purchasing. What does that mean? Now let us consider we are having a basket of goods or wheat or rice, but it cost us 100 rupees. But the same basket of goods or wheat or rice after 1 year it will cost around 108 rupees. Now the increase in the cost is tell us inflation. It is not tell by me, it is tell by the government by the data called consumer price index. The consumer price index in India shows around 8%. Okay. Now if we keep our cash 100 rupees in a cash form, then over a period of time it could lose its purchasing power. This is called inflation. Okay. To meet up with the inflation, we should invest that 100 rupees in an asset so that our 100 rupees will become 110 rupees. That is the return of 10% over a period of time so that we could be ahead of inflation. Benjamin Graham says in 1960 itself, the fear of inflation started in the stock market. The investors at that time, seeing that considering the inflation in their investment part, by considering the inflation, they are building a strategy to invest their fund in different asset classes. Okay, now the rising inflation is at 8%, but the bond yield return is around 6%. The investors consider that the bond investment is a stupid thing, so that everyone considering that only having a 100% stocks in their portfolio. But Graham says it is not the correct way of investing, rather than everyone should have at least 25% of bond in their portfolio. Okay, in the rise in inflation period, every people tend to have more money to spend. But in the marketplace, there will be a lot of demand for their products because every people have money to buy the product, but the product will be in demand. To meet up with the demand, the companies will start producing more products by getting a loan from the bank. Okay, now this situation is happening, keep on, but side by side, the cost of goods also keep on increasing. Now, at certain point, the people will dishappy with the increasing in the price of their products, so that they complain the government because of them only the prices of goods is so high, so that the government is pushed to hike their interest rates. Now, people rather than spending their money, they will keep their money in their fixed deposits in their bank because they are getting a higher interest for their money. Now, in the case of the companies which produced more goods, they have bought a loan to meet up with the world demand. But now the demand is also decreased, but the company should repay its loan now in the higher interest, the increased interest by the government. At the stage, even the company can go default because the interest rate also rises and their product selling also decreases. Okay, that company is nothing but our stock we are buying in the stock market. At that situation, if we are having our 100% stock portfolio, then we can tend to lose more money rather than we are parking our money in our bond. In bond market, our investment is protected and we can get an adequate return over a period of time. Even though our return is immediate or normal to the adjusted inflation, but we can get the adequate return from it. So that Graham suggests always we should have a 25% to 75% of bond portfolio. Rest of them only we should have in our common stock portfolio. Okay. Now the Graham says in the rising inflation period, the company tend to sell more products so that their corporate earning should also be high. But no one should get fooled by their corporate earnings in their rising inflation situation, so that we should wait and see the absolute return by the company and we should invest in that company. Okay, now let us see how to invest and beat the inflation. Graham says there are two ways. The two ways are investing in gold and investing in real estate. Investing in gold always a good one because over a long period of time, investment in our gold will always tend to do much better than the rising in inflation. But the downside in the investing in gold is we should always pay money to keep our gold safely in the bank locker. And the second one is we cannot get any interest or a adequate return from the gold investment. The second investment Graham suggests is buying a real estate. In the real estate investment, we can get a adequate return and also capital appreciation. In the rising in inflation period, we can also increase our rent for our real estate so that we could match up with the inflation over a period of time. This is a true investment suggested by Graham rather than investing in bonds and stock. Okay, now let us see the money illusion said by Jason Zweig. Now let us consider two situations. In situation 1, we go to the employee and say the inflation is rising by 4% and we are giving you a 2% hike this year. The employee happily accepts that situation. And in the second situation, we say that there is no increment in your salary, but the inflation is raised by 2%. Now the employee is so sad with that situation. Because whenever an investor see a positive sign in their portfolio, that doesn't mean they are in a good position or ahead of inflation. In the both scenario itself, it is the same situation. But in the first scenario, the investors see some positive return in their portfolio so that he is happy. But the true case is he is still 2% below the inflation returns. Okay, let me conclude this chapter, the investor and the inflation, by saying that after 5 years, we don't know where the stock market will go or where the interest rate will be there and how high the inflation will be. We should not get confused by that and all. We should always follow the Ram's defensive investor rule by investing in high grade bonds and a common stock portfolio so that our promises to our principal and we can get an adequate return from it. So that's it for this chapter, and let me see you in the chapter 3, the history of stock market. Thank you. Stay tuned.